CNBC TV18 exclusive. TV Narendran of Tata Steel has backed the industry's call for more curbs on Chinese steel imports. His thinking is this: the Chinese industry is in trouble and it should not be allowed to export its problems into India. Listen in to TV Narendran speaking to my colleague Latha Venkatesh.
It's a good beginning because it's a problem which we last experienced in 2015 when more than 100 million tons of steel was exported out of China. It's the same thing happening now. And the big problem is they are selling steel at prices at which they are losing money. And this is having its impact on the rest of the industry across the world. Other countries have taken action, and I think India should certainly look at taking some actions.
You know, during the results presentation, you told Nigel that even at that point, the Chinese steel was losing money at about $50 to $60 per ton.
That's right.
It still continues at that level?
Absolutely, it does. In fact, since then the steel prices have dropped. To some extent, the iron ore and coal prices have dropped, and that's helped support or limit the losses, let me put it that way. But the problem is acute, and the financial statements of the Chinese steel companies state the obvious. And the chairman of the biggest Chinese steel company, Bao, has also himself said it publicly that the industry is in very bad shape in China. So I think we should not let them export their problems to us. I mean, that's a fundamental point.
You know, Naveen Jindal, when the minister said that it will be about 7 to 12%, Naveen Jindal said that's not enough. What is a good number according to you? 15, 20, what would be the right number?
No, I know this is a difficult one simply because there are a lot of steel consuming industries out there who like low steel prices, right? So I think it's about finding a balance where the industry can make reasonable profit so that it can reinvest that money to build new capacities. India is blessed with iron ore. Why should a country like India, which is blessed with iron ore, be importing steel? You know, it's quite ridiculous. So I think the point is, we have iron ore. We shouldn't be exporting iron ore and importing steel. We should be converting that iron ore into steel. We should be a big exporter of steel.
It should be ours. It should be our terrain. But 17%, that's what some brokerage reports told us.
I think it's like this. You know, honestly, in this industry, unless you make a 15 to 20% EBITDA margin, you will not have the cash flows required to build new steel capacities. Because building steel capacities is a lot of money. It's $1 billion, a million tons roughly, right? So you need that 15 to 20% EBITDA margin, and otherwise you will not be able to build capacity. You can survive, but you will not build new capacities, and India needs new capacities.
I'll come to that EBITDA per ton.
Yeah.
I'll go from economy to the micro. But just to finish this argument, how is China looking right now? I mean, it's about 6-8 weeks since we spoke to you after your results. Has it improved or has it gotten worse? I
think it's not improved, certainly. The problem is being felt in China as well. Most of the Chinese steel companies continue to lose money. There are some closures of capacity, but the demand is also not recovering. So the problem is there. And while the steel industry is an example of what's happening, but I think this is applicable to all industries. I mean, so I think as other countries are also seeing, we should have a view if somebody like China is exporting a lot of whatever they produce at prices that kills the local industry, what should be our view? Should we allow it? Should we not allow it? And which is what the EU is doing, the US is doing, Canada is doing, everybody else is doing.
Yeah, I know EU has gone with for solar and for
EVs.
That's true. But yeah, as you say, there is the local unit, steel using unit, which will be rejoicing when import prices are lower. But to come back to the demand situation, how is the demand situation in India? Will it be hit if you got this tariff and prices became higher?
I don't think so, because prices have dropped $100 in the last 6 months. The demand was fine 6 months back. So I don't think anything is going to change that way. I think the point is in India, well, the demand is reasonably strong. It reflects the GDP growth rate. This is a lean quarter because of monsoons. Construction activity is a bit low, which is typically where a lot of steel goes. Auto has been going strong, but of course, just now we're looking at the stocks and dealers, etc. But otherwise, auto has been strong for the last few years. We look at commercial vehicles, slow down a little bit.
MHCV was slowed down for the August number.
Slowed down a little bit. Two-wheelers look strong, which means the rural economy looks like it's better. So overall, steel consumption is okay. But we are not able to export because international prices are so bad. In fact, that's another problem.
But how is global demand?
Global demand is okay. Some parts like the US is fine. Europe is still struggling to recover. Middle East, Africa is not bad. Southeast Asia is okay.
But you're getting undercut.
I think the problem which we are facing, everyone else is facing, right? And hence they're closing borders.
So this quarter margins could be lower than Q1?
Well, yes, but like I said, coking coal prices and iron ore prices have also dropped. Coking coal has an impact on our costs. It's not dropped enough. At today's steel prices of what it is, I think coking coal should be much lower, you know.
No, 13,800 rupees per ton, if I remember right. Second quarter EBITDA per ton. It could be how much lower you think?
I won't give you a guidance because
but the delta could be lower, you think?
Delta could be lower, which is what we guided in the last...
You did. Yes. What about Netherlands? Even in Netherlands, you were EBITDA positive.
Yeah.
Will it remain positive but a lower level?
Yeah, so it will be positive. I think in Netherlands last year was a bad year for us because we had one of our blast furnaces down for a relining. That blast furnace is back. We are back to full production. So our internal challenges that we faced last year are no longer with us. We are operationally running well, but the markets are bad. Again, a reflection of what's happening in China and elsewhere. So yes, it will be positive EBITDA, but obviously margins and spreads are squeezed because of what's happening.
What about the EBITDA loss in UK? UK is a twin problem. It was still an EBITDA loss and the government has changed. So how do things look in the second half?
Sure. I think in UK our plan was always to transition to a greener process route, which also is a more competitive process route for us because UK has scrap which it exports, right? So instead of importing iron ore and coal and making steel, we said let's use a local scrap and it will be greener steel, which was the business case which we presented to the government and they're supporting us. Let me say that the conversations with the government have reached a very, very good stage, and I don't
By
want
good,
to say
you mean
more,
positive?
Very positive stage. I think very quickly you'll hear some announcements.
That's extremely positive. So let me just extend the time horizon a bit. Your Neelachal expansions will be, are underway anyway. So if you want to guide us for FY26, do you think by then, because of volumes, you will be able to do a better EBITDA per ton? What can you guide for 26 and 27?
Sure. I think the critical milestones for us this year, one is UK, moving ahead with the transition plan. That will at least stop the bleed for us in UK because that was a big negative for us. Netherlands, which was traditionally positive but last year negative, will be positive this year and will continue to be that way. Obviously we are concerned about the margins because of the market. In India, the big milestone is getting the Kalinganagar expansion completed. The blast furnace should start in the next couple of weeks. So that's a 5 million ton expansion. So most of that volume will come through for us next year. Higher volumes in a high fixed cost business like ours means more competitiveness. So yeah, so that's where it is. So I think in all three major sites, we should see some positive developments.
On that note, we take a short break, but don't go anywhere. When we return, we'll tell you all about the Windsor EV, which has been launched by the JSW MG Motor India joint venture. We speak to Parth Jindal and Rajiv Chaba.